We've been talking all day about the idea of distressed investing.
Right.
Maybe it's becoming a little bit more attractive. I mean, for years, you had the Fed. You're basically competing with the Fed, and there wasn't much distress out there.
So look, we obviously went through a big distress cycle that was very short-lived because the Fed stepped in 2020, but it was incredibly profitable. The last couple of years, there's not been a lot of distress, and I will say, there's not imminent distress in the U.S. market today.
Right.
There's been some erosion of equity market cushion, obviously, as stocks have gone down. But fundamentally, corporate America is still doing okay.
Yeah.
And the jury is out as to whether or not this rise in rates is going to lead, and inflation is going to lead to a recession. But we're not there yet, but we're certainly getting ready, and you never know geopolitically how things might evolve, cyber how things might evolve. And so, again, our view is you always want to be ready to seize the opportunity in distress. But you know, right now, we don't see it as strong in distress.
I am curious, though, that as the Fed tries to sort of, I guess, normalize policy or become a little bit less accommodative, do you worry at all that if we do see some real economic trouble, the Fed would pull back on that and effectively, I guess, become a competitor again in certain spaces?
Look, I think right now there's one fight that the Fed is fighting, and that's inflation. There's no doubt that they are on the late side of that. Labor costs out of control. Energy prices obviously have ticked up materially, supply chain challenges, and so the Fed is behind. But the Fed has said very clearly they're going to make a difference. And you look at the screens, the market will tell you when the 5 years at 3%, up more than 200 basis points this year, it's telling you the Fed is going to raise rates, and a lot of that's in the market today. So,
okay, well, let's talk about those rates. We talk about looking at 3% now on the benchmark 10-year yield. Most people anticipate that goes higher here. What does it look like for risk-adjusted returns in this new environment?
Well, it's interesting because I feel like this environment is actually a great environment for corporate credit for what we do at the risk of being self-promotional or strategy promotional. I look at the equity markets and I feel like after so many years of double-digit increases with higher rates, a little bit lower growth, a little bit more pressure on margins, I think equities have a lower expected return than they've had over the last 5 years. I look at fixed income, I look at treasury yields, and it seems like it's sideways. Maybe you lose a little bit as rates tick higher a little bit. And corporate credit, what we do, because there's still so much equity cushion, the opportunity in private credit to make unleveraged high single-digit returns with a little bit of leverage, low double-digit returns, we think that is actually the sweet spot of the market opportunity. We also want to be ready for distress. We think Europe could get interesting on distress because Europe's challenges are quite different than our own. Europe has...
Do you think Europe's going to go into recession?
I don't know if it's going to go into recession, but they don't have the wage inflation we have, but they have much more vulnerability on energy and commodity costs. And by the way, they also have the Ukrainian war at their doorstep. And so there is now legitimate fear in countries like Germany, where I have many friends who are getting ready in the eventuality or the risk of something happening that's more local. And so I think Europe is much more exposed to recession risk in the near term. I think the U.S., I think we ride out some more here. The Fed's going to be aggressive, but I think that we're going to ride for a while here before we see recession.
Let's just stay on Europe for one quick second, because with regards to the energy issues they're dealing with, and now a lot of talk about whether they need to transition to, some sort of new regime, whether it's renewables or something that's not Russian gas and oil. Do you think that there's an investment opportunity, a case to be made, at least in the shorter term, where you can find opportunity as they make that transition?
Well, look, I think that we happen to have significant energy services positions that have done extraordinarily well from us, that we actually bought out of the last distress cycle when energy was under enormous pressure. And I will tell you that we still think there's room to go because we're not going to snap back to low energy prices in our view. The structural pressure in the markets, forget about Russia, Ukraine, and that impact, but the amount of demand versus the shutdown of a lot of supply over the last few years, we think it's going to lead to more higher structural energy prices for a while. And so being in service categories, and look, being involved in renewables and that whole transition to sustainable energy, there's lots of exciting opportunity. But I think in the traditional services space, there's still some money to be made.
What other sectors are you looking at?
Look, I don't want to say we're agnostic, but we really focus on finding good businesses.
Okay.
And so what we have a very substantial investment in the software sector, because software has really become the next generation of U.S. economy. Yesterday I saw the CEO of Honeywell, and 20,000 of his 100,000 people are software engineers. Wow. So there's, how do you take equipment, but how do you make it more useful? And so we're involved in a lot of enterprise software companies.
Are you seeing those types of ratios show up at other industrial companies?
Look, we're certainly seeing the digitization, the use of software, the way to increase productivity as major trends. And by the way, productivity is what may help us ultimately on the inflation front. And productivity helped a lot in the early days coming out of COVID. We'll see if we can prolong that productivity.
What does it take to get there, though? Is it just more investment from private investors, or do you need more government involvement?
Look, I think that I fall on the side of private investment leading the way with government providing tactical support in areas that are underinvested.
Okay.
But there is enough incentive for private enterprise to do it. And I do think to some extent part of our inflation challenges here is the amount of stimulus maybe went too far.
Right.
And that was very, very inflationary. And again, when you take people out of the labor market and then you increase your labor costs, that's pretty significant. So I worry about that.
Circle back to the start here. Does all this make you a more popular guy, or at least Oak Hill?
Look, I will tell you that I certainly have a lot of friends here, but to me...
Are you making new friends?
No, I always make new friends everywhere I try. To me, this whole question of where do people deploy money in this moment in time, where equities have gone up so much and now seem to be adjusting, where fixed income core feels a little risky, alternative credit, whether it's from the institutional market or the whole retail penetration, which is a major trend because obviously the retail investor is so underinvested in alternatives, and yet they have not had the access that institutions have had. So I think there's lots to do, lots more friends to make, and hopefully good results that go with it.